Bitcoin is leaving the 4-year cycle behind. And the craziest part is that almost nobody realizes it, or they're simply in denial about it. If you've been following me for some time, you would know that I've been saying the old rhythm that traders lived by for more than a decade is slipping out of the driver's seat. It's dying. The big rallies, the crushing pullbacks, the just wait for the halving mindset. That script, that mindset made sense in a world where Bitcoin was still a retail experiment. But the world has changed. The world we are in today looks nothing like that one. So over the next few minutes, I want to show you the signals sitting underneath this market that explain why the behavior feels confusing, why the reactions feel off, and why the next move for Bitcoin is showing up in places that most people are not looking at. We are currently walking through the moments that are laying the foundation for the next 2 to 3 years and what they will sit on, what they will be built on. And once you see how these pieces all click together, the noise of the last few weeks will start to make a lot more sense, and hopefully you'll start to relax and see what's going on. But all right, let's break this down and start right where the tension is building. Markets look calm right now, but anyone who's been watching the setups and the greater forces at play can feel the pressure. Bitcoin has been drifting quietly in the low 90s, and stocks and FX are basically waiting for the next headline. So on a superficial level, things may look boring, but we know if we look beneath the surface, as I always say, there's typically something else brewing. And QCP Group summed it up better than anyone else this week. They said, I quote, "The market is calm on the surface, yet tense underneath." And they pointed out that everything is running in a holding pattern ahead of a politically loaded, which I agree, FOMC meeting next week. That tension we're all feeling online is showing up in the data too. Let's take one very simple example, okay? The US deficit shrank almost 30% in October compared to the year before, and tariff revenues pulled in more money into the government instead of the economy. That drains the liquidity from the system, and bank reserves are thinning out. But repo markets are getting jumpy. Funding stress always shows up quietly at first, and that is exactly what we're seeing right now. But when you look at Bitcoin moving sideways and think the market is relaxing or for sure going into a bear trend, just remember what the institutional desks are saying, the greater forces. This is the quiet moment before the next macro push. And I believe that firmly. It's so obvious to me. Therefore, the surface is calm because everyone is waiting for the signal that forces the next signal round of liquidity decisions. But all right, now let's talk about why the Federal Reserve matters so much here. And that is because this is where the old 4-year cycle really starts to fall apart. But before we zoom in on quantitative tightening ending and the Fed's role that has changed forever, let's first do a quick recap. Because on December 1st, just a few days ago, Monday, the Fed officially ended quantitative tightening, QT. And that was reported everywhere. But almost nobody talked about the part that actually matters. Quantitative tightening ending is not just a policy shift, but rather it marks the moment the Fed stepped fully into a new role. And what is that role? Well, it's one they have been building towards since 2020. Back then, the Fed used to be the lender of last resort. But today, with the standing repo facility running in the background, it behaves more like a tender of continuous resort. The moment reserves get tight, banks tap the facility and the Fed quietly stabilizes the plumbing. Funding markets are preparing for leadership changes at the Fed and for a potential insurance cut next week without fresh CPI or jobs data. But what's really important here is that policymakers are making decisions with less visibility than usual, which means the reaction function is now more political and more preemptive than people think, meaning more predictable. Rate cuts reduce the government's interest payments, which means fewer dollars flowing to households and investors. But if we combine that with shrinking deficits and rising tariffs, you end up with a liquidity drain hiding inside a supposedly bullish headline. Cheaper debt for the government means less income for the private sector. Therefore, when you zoom out and you see how all of these pieces fit together, it becomes clear why Bitcoin's behavior looks different. The Fed is no longer raising and cutting in a clean cycle. Instead, it's managing liquidity in real time. The old 4-year Bitcoin rhythm depended on retail emotions and having supply shocks. But the rhythm we are moving into depends on liquidity stress, repo activity, and the moment a new emergency program comes out of the Fed's toolkit, which I know is coming. I think I said this months ago, long before Trump said he was cutting a stimulus check. I just know it. I said it, he's going to do something. But all right, now that we've set the stage for how the macro system actually works today, let's switch gears and talk about the cycle shift happening directly inside Bitcoin and the institutions that own it. So let's get into the part Bitcoin cares about most. Bitcoin reacts to liquidity pressure long before the headlines catch it. That has always been one of its superpowers, and it matters even more inside the system we trade in today. You can see this in the timing of Bitcoin's moves. It often shifts directions days or weeks before traditional markets understand what is even happening. We therefore have a situation where when bank reserves tighten, when funding desks adjust their internal models, and when repo usage rises for several sessions instead of one, Bitcoin picks up that signal almost immediately, like clockwork. It's close to the plumbing of global liquidity. And a great example of this showed up earlier this year. The dollar sold off at the same time US equities sold off. This combination rarely ever happens. So this is a sign that foreign capital flows were shifting in real time and that global carry trades were unwinding beneath the surface. Moves like that, like this, reveal how deeply Bitcoin now sits inside global money flows. It responds quickly because those signals reach Bitcoin long before they reach traditional assets, because it's the most global and truly free market in the world. And this is why the old 4-year rhythm feels out of sync. It's definitely one of the major reasons, because Bitcoin used to respond mostly to events inside the crypto economy. It was very niched. Today, Bitcoin's world has grown exponentially. Today, it reacts to signals that live inside the cross-border funding system, inside foreign exchange flows, and institutional liquidity decisions. So the halving still matters. I'm not saying it doesn't. But the cycle forming today is shaped by forces that sit far deeper in the financial structure. Therefore, when people say Bitcoin's reactions feel strange or disconnected from the new cycle, myself included, this is one of the reasons why Bitcoin is following the liquidity map underneath everything else. And this shift is what leads directly into the new institutional cycle taking shape. This is where the 4-year rhythm gives way to the cycle that institutions are building this time. And one of the biggest shifts happening right now comes from who owns Bitcoin and how they manage risk. We used to live in a world where retail traders, miners, and early tech believers drove the scene, okay? They drove the rhythm. But as I was saying, that world has passed a long time ago. You have to adjust to that. We talked in the last 2 shows about a huge access shift from firms like Vanguard and Bank of America. And I want to bring that up again because it sets the foundation for everything else happening next. Because the moment those doors opened, Bitcoin entered a completely new world. And here's the part I want to talk about regarding that. Once Bitcoin moves into institutional portfolios, it stops trading on a halving clock and starts trading on an institutional clock. Fiduciaries, basically fund managers, advisors, allocators, they live inside fixed performance windows, and most of them operate on 2 to 3 year horizons. And they set return targets, rebalance on schedules, and adjust exposure based on investment committee approvals. That timing becomes the rhythm of the asset. And we saw the first wave of that when Vanguard turned on ETF trading and volume exploded across the entire spot Bitcoin ETF complex in minutes. We also saw it when Bank of America prepared its advisors to begin recommending 1 to 4% Bitcoin allocation starting January. I mentioned those shifts already in early episodes, and I wanted to highlight them again because they are the opening notes of this new cycle. And once Bitcoin is inside model portfolios, the flows follow a predictable pattern. Allocations drift, portfolios rebalance, committees review performance, and exposure adjusts based on calendar-driven mechanics rather than emotional trading. And that creates a steady pulse that moves in multi-year waves, not 4-year signals, guys. So this is the new Bitcoin cycle. It is powered by institutions who build positions gradually, reduce them when mandates require it, and reload when portfolios reset. So once you see that timing clearly, the behavior on the chart looks very different than the pattern traders memorized for the last decades. So now let's look at how this new cycle shows up inside real companies, because their balance sheets tell the story even more clearly. And as we do this, I wanted to bring us back around to touch on Strategy's recent drama, which I've talked about also in previous episodes. Except today, I want to focus on the bigger picture because Strategy is the first large-scale example of what a corporate Bitcoin balance sheet looks like in this new macro world. We know they hold around 650,000 Bitcoin, which is roughly 3% of the entire supply. We also know they recently raised $1.4 billion through equity issuance, and that pushed their market adjusted net asset value back to about 1.4. And the important part here is not just the number, it's in the structure. Strategy now runs a business model built on asset and liability timing. They have obligations to preferred shareholders. They have access to capital markets. And they have a huge Bitcoin position that the market values almost minute by minute. And all of that combines into a balance sheet that behaves more like a Bitcoin-linked credit engine than a simple treasury. And actually, Decrypt reported that Strategy faces another potential catalyst soon, the MSCI Index eligibility review on January 15th. And if MSCI decides companies with more than half of their balance sheet in crypto do not qualify for certain indexes, that would affect the positive flows that track those benchmarks. That is a serious event because index inclusions shape demand. So we'll have to see how things play out. But this means ultimately that Strategy becomes a real-time example. It teaches us how institutional structures, rating optics, and index politics all converge and blend together. And it shows why the next Bitcoin cycle will rise and fall on decisions made far outside the typical crypto conversation. This is also what I've been saying for a long time here now at my channel, that the macro conditions, the larger forces in the market, are now affecting Bitcoin. Bitcoin is not siloed anymore. Its world has expanded. That's why it's also impossible to know exactly how Bitcoin pans out, how it runs, how far it runs this bull cycle, or when the bull cycle really ends, or where we are in this bull cycle. Because everything about Bitcoin and its timeline and the forces at play have changed. They've morphed, they've expanded. That said, let us put a pin in that thought. I'll be tracking the Strategy story, situation, drama, whatever you want to call it, in close detail, so stay tuned if it interests you. But now I want to talk about Tether and the reality behind the FUD, because Tether's balance sheet plays an even larger role in global crypto flows. So let us examine what its structure tells us about the next phase of this cycle. For many of you who have been in crypto for a long time and are here tuned in, hello, you and I would know that Tether in many ways has been a lightning rod for years. So let's lean into what's new about it. Right now, we know that the S&P Global recently downgraded Tether's ability to maintain its USDT peg to junk, and headlines went wild. Then we saw the attestation report from September 30th, and it told a very different story. 70% of Tether's reserves sit in cash and cash equivalents. The remaining 30% is a mix of gold, Bitcoin, and secured loans, backed by an equity buffer. And Arca's research team explains something that many analysts forgot in the panic. For Tether to face a real liquidity crisis, more than 70% of USDT would need to be redeemed overnight. And that scenario has never even come close to happening. The structure of stablecoin flows makes it almost impossible. But a solvency issue is different. Even then, though, the parent company earns enough money from government interest to absorb reasonable losses in that risk bucket. Does that make sense? Let me know if this doesn't make sense in the comment section. And Jeff Park actually said something quite comical, if I could say so myself, and definitely quite true. He said, the entire fiat system is based on theoretical insolvency. Every major country runs a version of it. Fractional reserve banking depends on it, true. Therefore, the question is always whether there is enough liquidity to meet the moment. That's the real question here. And Tether's latest attestation shows real liquidity and real profitability. Moreover, USDT has held its peg through the entire downgrade. So why does this matter for Bitcoin? Well, it matters because stablecoins anchor the on-chain dollar system. They are the bridge for trillions of dollars in global trading. So if you want to understand the next Bitcoin cycle, you need to understand the balance sheet mechanics of the asset that touches every trade. But all right, now let us bring it home. In today's video, we talked about the new rhythm going on with Bitcoin. We started with a simple idea, Bitcoin leaving the 4-year cycle. And after walking through everything happening beneath the surface, the new rhythm becomes clear, or at least I hope it did for you. Let me know if this doesn't make sense. And we now know liquidity is driving this market. Institutional incentives are shaping its path, and corporate balance sheets and stablecoin engines are anchoring the flows. And perhaps most importantly, policymakers are preparing new liquidity tools in response. And Bitcoin watches all of it. It reacts early. It reacts to liquidity stress. It reacts to signals that the next intervention is coming. It reacts to the signal that says the next intervention is coming. The halving still matters, yes, I'm not dismissing it, but it's no longer the heartbeat of the cycle. Times have changed. The next 2 to 3 years will follow a new script. And understanding that script is how you stay ahead of the noise and stay aligned with the structure forming underneath all of the superficial chaos. So if this gave you a clearer view of where Bitcoin is heading, share it with someone who still thinks we are stuck in a 4-year loop. I look forward to your questions, your comments, and suggestions on new video topics. And we are preparing a deep dive into my favorite blue chip tokens and why. And also a new project, I hate to create FOMO, but a new project that has been stirring a very interesting marketing approach backed by huge backers. And I want to bring it to you here and explain why I think this project could do very well, though it's not financial advice. Anyway, I love you guys, and I will catch you guys here tomorrow. Take care.